Hey everyone! Welcome to the very first video on HK Market Guru. I'm super excited to have you here. If you're interested in the Hong Kong stock market, whether you're a seasoned investor, just getting started, or simply curious about what's happening on the HKEX or in the right place, this channel is all about breaking down the Hong Kong market in a way that's simple, clear, and actually useful. No confusing jargon. No fluff, just straight, talk about opportunities, risks, and smart strategies. To kick things off, I thought, what better way to start than by jumping straight into the action? In this first video, we're going to look at 3 hot HKEX stocks that are making waves right now. These are companies that I've been keeping a close eye on either because of their strong fundamentals, major news catalysts, or price action that's too interesting to ignore. So grab a coffee, get comfortable, and let's dive into the Hong Kong market together. Don't forget to hit subscribe if you want to stay updated with the latest insights, analysis, and stock picks from the HKEX. Let's go. The first stock that I want to talk about is, to no surprise, CK Hutchison Holdings. Now. CK Hutchison is one of Hong Kong's oldest and most diversified conglomerates, with operations in ports, infrastructure, retail, and telecom spread across Asia, Europe, and beyond. Yet, despite this global footprint and stable cash-generating businesses, the stock is trading at around 7 times forward earnings. That's incredibly low compared to both its peers and the overall market. This low P/E ratio is a classic sign of undervaluation, especially for a company with such stable revenue streams and diversified risk. What makes the story even more compelling is its price-to-book ratio, which is below 1, meaning the market is pricing the company at less than the value of its net assets. In plain terms, you're getting their global business empire and real assets like ports and telecom infrastructure at a discount. This is especially attractive for long-term investors who value margin of safety. Let's talk income. The company is currently offering a dividend yield of around 5%, which is not only solid in today's interest rate environment, but also well supported by strong free cash flow. CK Hutchison has also recently unlocked billions in cash, attempting to sell its Panama Ports assets, approximately US $19 billion, which will not only strengthen its balance sheet, but also gives them room to reduce debt, buy back shares, or further reward shareholders with higher dividends. The company is also actively its debt level is improving, and with the recent asset sales, we can expect even more financial flexibility moving forward. This means less risk, more stability, and higher investor confidence in the stock's future performance. Lastly, don't underestimate CK Hutchison's competitive advantages. They're not a one-trick pony. Their exposure to stable, defensive sectors like telecom and utilities helps cushion the business during economic downturns, while their port and retail businesses provide long-term growth. The diversity in their operations across geographies and sectors reduces risk and provides multiple revenue streams. So when you combine a dirt-cheap valuation, strong dividend, improving balance sheet, and globally diversified business model, you're looking at a textbook undervalued blue chip stock. This is why I believe CK Hutchison Holdings deserves a place on your watch list or even in your long-term portfolio. Next, We're going to talk about a banking giant that's flying under the radar of many investors but offers serious value: Agricultural Bank of China. When we talk about value investing, one of the first things we look at is the price ratio, and ABC is trading at a shockingly low PE of around 3.5. That means investors are only paying about 3.5 times its annual earnings, which is dirt cheap by any global banking standard. It gets even better when you look at its price-to-book ratio, which is typically under 0.5. This means the stock is trading for less than half the value of its net assets. You're essentially buying this bank at a steep discount to its actual worth. Now let's move on to income. ABC offers a dividend yield of approximately 4.6%, which is highly attractive, especially in this environment where investors are searching for stable income. And the great news is that this yield isn't a fluke. It's backed by the bank's strong, consistent earnings and a stable balance sheet. Agricultural Bank of China is not a risky high-yield institution with government support and prudent financial management. In terms of operations, ABC has an enormous footprint across rural and urban China, serving agriculture, SMEs, and the broader retail sector. That gives it a unique competitive edge that many other banks don't have. It's deeply embedded in the real economy and plays a vital role in China's domestic growth strategy. While some investors shy away from Chinese financials due to macro concerns, it's important to remember that the Chinese government often steps in to support these institutions during downturns, which adds a layer of safety you might not find elsewhere. Also, with the Hong Kong listed H shares trading at a discount to their mainland A share counterparts, we're seeing increasing inflows from mainland investors looking to close that valuation gap. That rising demand can provide a strong upward push for the stock price over time. So to sum it all up, ABC is undervalued, plain and simple. You've got a world-class institution trading at less than half its book value, a generous dividend yield of nearly 5%, low PE, strong earnings, low debt, and the backing of one of the world's largest economies. If you're a long-term investor looking for value and stability, Agricultural Bank of China deserves serious consideration in your Hong Kong portfolio. Lastly, I want to talk about e-commodities holdings. At first glance, e-commodities might not be a household name, but don't let that fool you. This company operates in the commodity, logistics, and energy infrastructure space, which are essential services in the supply chain of raw materials. What makes this company stand out is how it's been strengthening its balance sheet and positioning itself for long-term growth while the market continues to ignore its real value. Over the past 5 years, they've cut their debt ratio dramatically from around 1.202 just 0.32. That tells us the company is becoming leaner, more efficient, and less risky from a financial standpoint. On top of that, their free cash flow is strong, which is crucial for any investor who cares about a company's ability to repay dividends or reduce debt even further. E-commodities has been generating consistent cash while expanding its operations in areas that align with the global shift toward energy transition and cleaner logistics. That means the company is not just surviving, it's evolving with the times and finding new growth opportunities, even though their exact PE and PB ratios aren't widely published. Analysts and institutional investors agree that the company is trading well below its intrinsic value. This is a classic value play a business. That's underpriced simply because it's not widely covered in the media or by analysts. When you combine this with the company's low debt, improving financials, and strong operational focus, it becomes clear that this stock is being mispriced by the market. And let's talk about the competitive advantage. Ecommodities operates in a specialized niche of commodity logistics, an area that requires scale, expertise, and long-term contracts. Not every company can just walk in and compete. That gives them pricing power, customer stickiness, and a protective moat that helps them stand out in the small cap space. These are all green flags for long-term investors. So when we're looking at undervalued opportunities in the Hong Kong market, Ecommodities Holdings checks almost every box. It's got low debt, strong cash flow, an undervalued share price, and a long-term strategy that aligns with global energy trends. It's not a flashy tech stock, but sometimes the best value is found where others aren't looking. If you're a serious investor hunting for hidden gems, this is definitely a stock to put on your radar. That's it for today's deep dive. If you found value in this analysis, smash that like button, subscribe to stay ahead of the curve, and drop a comment if you're holding any of these stocks or you have it on your watch list. This is HK Market Guru helping you spot tomorrow's winners today. See you in the next one.